where do you spend your money? Like if the Amazon ferry and FedEx stopped showing up at my house, I'd probably save a lot of money. But that's the problem of having our phones in our hands as often as we do. Oh, it's Prime Day, or everyone else is under the sun, and oh, this one's 38% off. I'm like, you know, it's 100% off. Not buying it.
Hello and welcome to Un Eff Your Finances podcast with your host, Nick St. George. I'm your podcast producer, RJ Mallard. Nick, how you doing?
I'm battling here. I had a little too much
Okay.
fun and paying for it now, and we'll call it the man flu for the week.
Yeah, we've all been there. All right, so on this episode, we're going to talk about year-end planning. So why don't you give us a little synopsis of what we're looking forward to on this podcast?
And I know it's just barely October, and all your hardware stores already have Christmas up, but at the same token, like year end is not that week after Christmas. And unless you have a DeLorean that has the flux capacitor, we can't talk about this in March. So year end plan, I really like to get it knocked out before Thanksgiving, because after Thanksgiving, you have holiday parties, everything else, family, in-laws, whatever it might be. And then it's December 31st, and we're supposed to get something done, and
Right.
you're off just like most of the back offices, and that's what we're going to talk about it now.
Okay.
It's more of a checklist. Sometimes there's nothing and everything's on point and you're good to go. But more often than not, it's open enrollment for your company. Hey, what do we do with our benefits? What about this, that, and the other thing? So it's really important to be proactive. Things you do, you don't want to do a fire drill in a fire, right? You don't want to get surprised when your CPA gives you your estimated tax bill March-ish and says, hey, you owe X. Why didn't you do any of these things? Oh, Nick said we should probably look at that. And I said, no. And it's like, have a little forethought, run through the numbers now, be proactive. And even if it's not any dramatic changes, it's still just to check in, make sure things are going well. Like life happens.
Okay. So you mentioned that it's a checklist. So why don't we go down the checklist and start with maximizing your retirement contributions?
All right. Yeah. Maximizing retirement contributions. One of the trickier parts, let's say you switch jobs mid-year and you put your max on one company and max on the other. They don't talk to each other. Doing a return of excess contribution is not fun because you got to calculate the earnings and the penalty and all the other stuff. So that's one nuance. But hey, how much are you putting in? Like you roughly want to be saving 10, 12% of the year of your income, not just your company's 3% match. So also look at, hey, there's Roth, there's pre-tax, like which one's best for you? Like that's why we look at your tax return with that Plans software. Do we need tax deductions? Is it a lighter tax year and maybe some Roth for the long term back end like benefits? Like it's one of those things. And what's that number? How much have you actually deferred this year? Because have those people that have switched jobs, they just put it to their normal thing. And it doesn't realize if you stay at your job all year, most 401k plans will actually stop you from contributing before you run into that. But if you switch jobs, they don't know that you had one at this and one at the other. And then going forward for next year, hey, if you can add 1% pre-tax until you get to 10, 12, or till you max out, whatever that number is, it's like my kids. They just want more. Like if you can save a little bit more, keep moving along. And 1% of the time, typically, hey, if you get a raise 3-4% and you say, hey, I'm going to add one, like you're still going to see typically a little bit more in your paycheck and you're saving, right? Yeah. It's a lot easier to save if it automatically comes out of your paycheck.
Okay, very good. Capital gains and tax loss harvesting.
So capital gains, everyone, hey, you want to make money, right? We invest to make money. You play to win the game, right? Like it's just one of those things. But tax loss harvesting, great way it was explained to me. It's like the Bed Bath & Beyond coupon. It's there if you want it, right? Like if we sell Coke and buy Pepsi, we're still having similar exposure in your portfolio, but we sell those losers, rebalance to where you need to be at, and you now have losses. Typically, you can write off, if you don't have any gains, you can write off $3,000 roughly, double check with your CPA. Or you can carry it forward. Let's say you had a bad year. We had, 2021, 22 was a little dicey. I forget which one. I try to forget the bad years, like most
Yeah,
people.
yeah.
But you sell off those losers. All right, hey, get rid of those dogs, rotate around, get you back on line to where you need to go. And that way there in future years, when you have a good year that so far, knock on wood, we're having a good year right now, that if we need to rebalance back to where your risk tolerance is, we don't have to worry about those capital gains because we have some coupons, those Bed Bath & Beyond coupons, offset them because they can carry forward. If you don't use them, it's not that you lose it, right? So it's there. That's just another reason hammering home, like looking at the holistic plan report of your tax return. Do you have carry forward losses? Do we have some wiggle room there? And then capital gains. What's our estimated capital gains for the year? With more of a shift to ETFs and individual stocks, we can control that a little bit more versus the mutual funds will distribute regardless if we buy or sell. But we typically can have a ballpark and say, hey, we're projecting out. So that way there we can look, see where we stand. Do we need to sell anything? Do you need to pay it quarterly? But it really will allow you to kind of take a peek at what April might look like, as well as plan for the future. The goal is to make money, right? We're fingers crossed. There are no guarantees outside of death taxes. And you're going to have gains eventually. How do you offset them, right?
So should you do this every quarter, every 4 months, once a year?
I'm checking quarterly and on the rebalances. Like it's an option because with the portfolio being a little bit more active, kind of a little ebb and flow depending on the different factors and what the signals are telling us. When we go to rebalance, I will typically option for tax loss harvesting. Technology is a beautiful thing. I don't have to go there line by line. I can select that as an option. Now, tax loss harvesting doesn't help you with your IRA, your retirement accounts. Like you don't get that part of it. So this is more your taxable, your non-retirement accounts that we're really looking at. But you take a peek. Like you might, hey, if January sucks, let's take those losses now, reallocate, and even if the year finishes up, if we book them early, once they're booked, they're booked.
All right, very good. Let's move on to the next item on the checklist, and that's charitable contributions. That can be very beneficial if you do it right, correct?
Correct. I always joke there's the NSG Foundation. My kids will thank you, but realistically, there's something important to you. It could be religion, it could be a school, it could be cancer. We're in North Carolina right now. I got to be impressed. The last 2 weeks, the amount of donations that people have put together. Pick something that's important to you. They got that concert coming up here in North Carolina in 2-ish weeks. Eric Church signed away his rights to his song to the state of North Carolina to help the mountains. Like
really, wow.
Wow. What's important to you, right? Charity starts at home, family, direct family. But if you have a charity or a church or something like that, you can actually do good and save on taxes. And there's a lot of different ways. If you have a massive income year, you can look at certain things like a donor advised fund. Like I'm not going to get in the weeds on this, but there's a lot of ways to do good, feel good, and save on taxes. Like it's a nice little trifecta right there. But I'm not going to sit here and tell you what charity to go to or anything like that. But you got to find something that's important to you. What is most important to you? What's going to make you feel good? Or what's an impact that you're going to see? I'm just picking on North Carolina. Florida's basically might be wiped out. It's still coming out. I saw the Devil Rays Stadium roof got taken right the top off.
Yes, I have family down there, so I've been in touch with them a lot. And fortunately, knock on wood, my family is good. But we still, there's still, a lot of damage down there. That's,
Yes. And that's something that's near and dear to your heart. As a family member, my old coworker, her house got wiped out in the previous storm, and they probably even worse. She's in the St. Pete Harbor area. Like she evacuated to Alabama. Hope she's all right. But this is some of and there's another one. I don't know if Florida does some type of charity, you could do stuff like that. You can even use your RMD to send to a charity. There's a lot of different ways of doing this. Once again, for this tax year, we got to do it before December. So this is why we're talking now before things get crazy. But truthfully, if there's things that are near and dear to your heart, something you want to go to, like You can save on taxes. There's different ways of stacking them up, and you can get pretty in the weeds with it, but do good, feel good, save on taxes.
All right, we're moving along on the checklist here. Next item is review your budget and saving goals. And I have to say, I am guilty of not doing this, especially when things are going well for me. But now I've run into some bills, and all of a sudden, I have to say this is the first time in probably a good 4 or 5 years that I'm actually sitting down and looking at my budget. And I know that's completely wrong. So I'm setting you up with this, Nick.
Yeah, I'll send you the worksheet to help you through that one, but it's scary, right? Like things are going well. There's always money in the account. Like, I don't know, winning hides all faults. So if you're doing well, everything's fine. You're less likely to look at the details. Hey, my job's fine. I'm going to keep making money. I'll hit that bonus, all those assumptions. And you just think, oh, we don't really spend that much. But if you start ripping through the numbers, and any new or existing client, they've seen the worksheet, and some of it's like, what the heck is this? And I'm like, I've seen one person that spent $350 a month on dog grooming.
Oh.
And that, I'm like, you're looking at the different expenses. Like where do you spend your money? Like if the Amazon ferry and FedEx stopped showing up at my house, I'd probably save a lot of money. But that's the problem of having our phones in our hands as often as we do. Oh, it's Prime Day, or everyone else under the sun. And oh, this one's 38% off. I'm like, it's 100% off, not buying it. But it is necessary. Take a peek. Just because you're making more money, are you doing anything with the savings part of it? This goes back to the 401k question, deferring extra. Try to automate it. Do it. Hey, if you get paid on the 15th, on the 16th of every month, send X to a different account. I do it for my own retirement accounts, kids' college savings accounts. Like, automate it. Like if I got to write a check, like I know my landscaper gets mad at me. I'm not a deadbeat. I just hate writing checks and I forget to do it, but automate those savings. If you go through a budget, all right, we'll keep it simple. You make $10,000 a month. That's great income, but you're spending 11. What's going on? You gotta leave some room in there. Think about it. You want to save 10% or more. So you need to be saving 1,000, and you go through that budget. Let's see what the numbers are. The other part is, are we saving? Do you have an emergency fund for 4 to 6 months? Another one, on top of that, hey, you're retired. It's a little bit different story. We'll have more money kicked around for safety, but that's more of a planning story. But your basic budgeting, 4 to 6 months of expenses. Do you have that? If you're a homeowner, do you have 1% of your house value in an emergency fund? Let's be honest. If you get a $500,000 house, you need at least $5,000 laying around for repairs, like HVAC, something. That's another one I really like that doesn't get talked about much in that planning, but you go through the numbers. Are we okay? All right, I can continue to buy bourbon and goof off. Or, hey, we need to slow it down and buckle up, Buttercup, and just we can't keep spending like a drunken sailor.
You have something here in your notes that I have in front of me, and it says, consider setting SMART. Can you explain what that is?
It goes back to, if I say, hey, you're going to save $50,000 in this next year, you're like, oh, what the heck? No, we need to do $100,000 a week. And I'm picking round numbers. They may say big, but you got to have math of what it is. What do I need to do this week, this month, this quarter? And that way you're not in December being like, oh man, $47,000 light. I wonder how I'm going to do this in 3 weeks. And but if you have those measurable hurdles along the way, life is going to happen. You might go on a vacation, whatever. Bill came up, oh, new tires, whatever it might be. But if you can check in and know what you need to be doing each month or every 2 weeks, then you won't get lost in the weeds. You don't want to get lost in the journey. Like some GPSs, they'll say, hey, you don't turn for 22 miles and it stays quiet. But like, hey, continue on this for 3 miles. Continue on this for 3 miles. Now, at the end of the day, you're still on there for 22 miles, but have a couple little reminders. Hey, what should I be at right now? And on the flip side, you might be ahead. Hey, it's been good. I got a surprise bonus or closed business, whatever it might be. Throw that little extra on there. If you know, hey, I was light a couple months and now I'm ahead these, like, and it goes back to having those hurdles versus just being at the end of the year, be like, oh, what the heck happened? Like, it does feel like it went like January, February now, and
Right.
we're going to blink twice, and it's going to be January 25, which is scary to hear 25, and we're not the Jetsons. Because as a kid growing up, I definitely thought we'd be flying around like that.
Right. Okay. I like that reference. Good reference. Let's move on. And here's something else I'm very guilty of. And now that I'm getting older, I just turned 63. Review and update estate plans. At this point in time, I'm just thinking, well, my wife's a little younger than me. When I go, everything just goes to her. So, but really, what should you be doing?
Hey, it's really important, and do it now when you're upright. You don't want to be bedside being scrambling. Oh, they're in a medically induced coma or something horrible like that, and you're figuring it out. This one is not an annual review unless you had a dramatic family change, birth, death, divorce, something like that. You can wait every, 3-4 years on this one, unless it's a big life event. But truthfully, double check your beneficiaries. When I first started on this side of the business versus like my compliance years, there was somebody, they got divorced, they got remarried, the ex-husband passed away. New wife comes in to inherit the IRA. Former wife, the ex-wife, is still listed as beneficiary. Ex-wife is holding the will, says, I get everything. Your beneficiaries, be it a beneficiary, a transfer on death, payable on death, depending on the account type, that trumps your will. Your will could say you leave it to the, PETA, but if you list people on all those accounts, that's where that goes. And one of my own early clients, I looked at their documents, who do you have? And it was just listed all my children. Now they have 3 kids and would probably figure it out, but I'm like, the amount of red tape and hurdles you need to go through. So with that estate planning, hey, make sure the will is updated every 3 to 4 years. State rules change all the time. Just like tax law seems every 2 to 4 years, there's a little nuance that changes the rules, but make sure you have transfer on death. Payable on death is typically your bank accounts. Not always a big fan of adding people as a joint, because let's say you add your son to your account. Son goes through a divorce. That's now a asset that's involved. You want them to have an authorized signer or payable on death, something along those lines, so it doesn't get looped in with everything else. But you do that planning now. You don't want to have to deal with going to small estate affidavit, go to the courthouse. You got to have the certified death certificate. It's a lot of legwork. It's not as easy of you like to think it is. Hey, they go first, they'll get everything. Now married, that's within wiggle room. There's still some weird parts, like cars are a pain in the butt, especially like South Carolina. That's not too far away. Like a client passed away 2 years ago that widow had some issues with she's like, I just want to sell it. I don't need 2 cars.
Right, that's what I was thinking. You just sell the car. What's the big deal?
And because the title had only his name on it.
Oh.
So it's all these little things that like, or my another one that's a good one I've heard. Well, all my documents are in my safety deposit box. Problem with the safety deposit box is unless somebody else is listed on a name, like you need basically a court order.
Right.
And even then they're hesitant that like they're going to drill. It's going to cost money. Like it's not, you can't just. So not only update the documents every 3 to 4 years, annually check your beneficiaries, make sure that's all right, but have a place. There's digital vaults I have for my clients that they can have it uploaded, but people need to know where it is. And that way there isn't like this scavenger hunt for where do you think they might have kept it? Or it's on a thumb drive. Good luck finding that thumb drive. Like if it looks like my desk, right? Like have some accessibility to it. And I'll even go one step further. I've seen some clients, they inherit a good bit of money and they still fought over who got what. Sometimes it's a step further. Talk about it. It might be more important for you to get the vacation home versus the stocks, or what it might be. Sometimes a little bit of conversation. You don't have to go in hard dollar amounts of, hey, you're going to get this or that, but maybe a little high level, because there's nothing worse than seeing grieving brother, sister fighting over a $15,000 spread.
Right. Yeah. I do have to say my parents did a really good job Everything is split evenly among the 4 kids, and we know exactly what happens. There's no doubt as who gets what. And, as I think we touched on this last podcast, my dad didn't do a great job of getting himself ready for retirement, so there's not a lot of money we're going to be fighting over. It's just basically the place where my mom is living. So, and we know that's 25%. Everyone gets 25%, and that's it. So we're set that way. So let's move on and let's look at insurance coverage checkup. Once you have insurance, isn't that all you need to do?
Hey, it's kind of like the fire extinguisher underneath your sink. You want the cheapest, best one and hope to never use it. Like you need to have it. A lot of people pitch life insurance as like the investment. No, that's the emergency net. Like you really don't want it. You don't want to use it. Are you rooting to die? Like it's, not like you let me go drink a 5th of vodka and go no seatbelt and see what happens. Like, no, this is, hey, insurance is to cover. Do you have an insurable risk? I like to look at it 2 to 3 times your salary, pay off your mortgage, cover the kids' finances, right? That if you do that, that's a good starting point. At the end of the day, don't say, hey, I want to get a policy for X dollar amount. Well, where'd you get that? Have a formula of why you're getting this, right? And yes, it's a lot easier. The younger, the healthier you are, the easier it is to get this stuff. You get a term, think about it. Like if you look at what it costs for some of these cash value policies, I have a spreadsheet. I'll show, I've gone through it with some other people, but at the end of the day, typically your insurable risk goes down. The mortgage is almost paid off. The kids are grown. You have built up other assets, right? You're typically, when you have a family, I don't know, say 30 to 65, you have typically insurable risk. There's something in there. As you get older, it goes down. Now, there's some estate planning things you can do insurance for. That's a different story. But your general insurance, have a calculator. Hey, I have X salary. I have this much debt. I want to cover these expenses. And then that's what you go and ask for. And the other thing, if you already have it, double check to make sure who your beneficiaries are. Once again, on the retirement accounts and payable on death, you want to make sure whoever's getting that policy is who you wanted to get it. Don't forget that, I set this up in my 20s. It's going to my girlfriend from when I was 22. Like, that's not what you need. Have a math factor on it. Have a reason for it. My mother recently asked, she's like, I got a flyer from the people that give you car coverage saying they'll give you really cheap insurance. I was like, Mom, what are you insuring? Like, Alex and I are grown. Like, she's like, well, what about my townhouse? And I'm like, well, we'll sell it. Like, whatever's left, all right, we'll go 50-50 and have a nice dinner, right? Like, it's not some massive windfall amount. Like, worry about saving for your retirement, doing other things. Don't worry about leaving money for us. We're good.
Okay. All right. That sounds good. Then we're moving along on the checklist here. And the next one is, and I'm sure everyone wants to know about this, maximizing tax liability.
And that kind of pretty much everything we've almost talked about kind of ties back into that. Tax loss harvesting. Can we make any additional IRA contributions or a SEP if you're a business owner? You do a lump sum on your 401k to lower that taxable income, right? If you're a W-2 employee, there's not a lot of ways it takes a lot. They made the standard deduction pretty large. So itemizing it gets tricky if you're a W-2 employee. Like, there's just not as many options to make that go away. So typically it's your 401k, 403b, whatever your company sponsored retirement plan is. You can do some HSA money, but where can you do it? And we can't fix your tax liability in March. Like, it's just too late. Yes, you can make some IRA contributions, but typically if you're having tax problems, you probably will make too much for those IRA contributions to matter. You got to talk about it proactively. You don't want to have that surprise in April for the CPA when it shows it. Like, we run through, hey, we have X money coming in this year. We might have a gain. Oh, we sold a property. All right, what can we do with this? You have the conversation now when you have your most options available to you. And that way all right, do we have to go harder on the tax loss harvesting? Let's chip away at this. How can we make this less painful?
All right. Very good. And this is the last on your checklist, and it's procrastination. Hurts. I think we're all guilty of that.
Oh yeah, no, we'll do it tomorrow, right? And tomorrow
Yes.
and tomorrow.
Yes.
No, you got to get into it. Sometimes you hear, "Hey, I don't want to do this. I was afraid to see what the number said. Hey, I don't want to do this. I didn't have time." There's a lot of different things. Trust me, I kicked the can on a lot of different things. We're all guilty of it. But if you take that first step, and maybe if you've never done it before, do it at least once, right? See, you might just to double check. This can be sometimes a quick conversation, 20, 30 minutes. You upload the documents. We rip through this. Hey, here's your 3 things. This doesn't have to be a shuttle launch. Now, we covered a lot of bases, but everyone's a little bit different. Like, do you need to worry about updating your estate every year? No, but that's something you still need to at least talk about occasionally. Tax loss harvesting. This year's been a good year in the markets. Not exactly an easy one to do. Like, you can't create losses when they're not there. But you kind of go through this checklist, you knock it out, you have peace of mind. There's something said for knowing you're right, wrong, and different versus just being like gut punched in April.
Yeah, that has happened to me a few times where you go in, you think, okay, everything is fine, and then all of a sudden you have this big bill and you don't know where it came from, and it can be very discouraging. I can't tell you, there have been a few times where my wife and I have left our financial advisor and our accountant, and we are thoroughly depressed because of all the money that we have to pay, by April 15th. So this is a great checklist to go down, and it's something that should be reviewed. What do you think? Quarterly, every 6 months?
Now, you can break it up. Like, some of these questions are quarterly questions. Like, it doesn't have to be all 8, 10 at once. We could ask 2 or 3. Like right now, open enrollment's big for a lot of the bigger Fortune 500 companies, right?
Right.
Hey, should I do HSA or this? What's my 401k? So can I up my employer sponsored health life insurance, right?
Yeah.
Those are some of the things that are tail end, right? Then we look in the front end. Hey, what are your IRA contributions going to be? What are your 401k? Like, there's different parts. We don't have to do it all at once. But the other thing I do find is we got October 15th coming up in a couple of days. That's typically your extension deadline. Everyone by now has last year's tax return, because that's usually a nice little picture into what happened. What can we expect for next year? What's different? And we're late enough in the year. Did you do as well as you did last year? What's happened differently? And now we have both the tax return and a decent guesstimate of your annual income. So that's why I'd say most important now, or in the next 6 weeks-ish, right? After October 15th, pretty much everyone's been filed. And then before Thanksgiving. Because once you get to Thanksgiving, people it gets crazy.
Okay, very good. All right, Nick, appreciate all the information. A lot of great information. How can people contact you?
You can always go to the website, stgeorgewealth.com. Nick at stgeorgewealth.com is the email address. And the phone number, 828-481-8836. It goes to my cell phone, but that's the work. It's to make all the compliance people happy.
Sure.
So it goes to my cell, but it's like happy compliant to the cell. So that's text, call, all that fun stuff. Okay. Whatever the best way to get a hold of you. I know we got LinkedIn and the Facebook profiles linked in below. So
good.
Give me a connect. There's a YouTube channel.
Very good. All right, Nick, thank you. I appreciate your time. Interesting topic. And we look forward to your next podcast. And thank you for listening to today's Un Eff Your Finances podcast. Please like, follow, and share this podcast with friends and family. Until our next podcast, I'm RJ Malik.
Thank you for listening to the Un Eff Your Finances podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.stgeorgewealth.com or give us a call at 828-481-8836. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of St. George Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC.
Any guests in their company or companies are not affiliated or endorsed by LPL Financial unless otherwise stated. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.